Good morning, it's Jeffrey Cohen. Hopefully you're doing well out there. It's January 22nd, and we've got a lot to talk about. We've got a ton to talk about. And so, you know, I'm looking at the markets yesterday. I was looking at the markets yesterday, and I saw something a little odd. And so I wanted to share it with you. I'm going to go over to FinViz, just a nice simple visual how the markets did. We're going to talk today about new lows versus new highs, and we're going to talk about how we think the market might do. So if you take a look on FinViz, I'm not sure if everyone even knows how to read these. So let's just explain it. A NASDAQ. The relative volume yesterday versus, I think it's the last month, is 1.0. S&P 500, it's 1.0. So what that means is you did not have any increase in volume, you had the same volume. Now let's take a look at what happened. And again, you can get this every day on FinViz. So the market gapped open. So what that means is it closed the day before at 10,800. It opened right around 11,000. So for most investors like you and me, we're not able to capture that. So that's done pre-market. Do you know my brokerage account, I'm not even allowed to trade pre-market? I don't even know how. I'd have to change brokers. And for most, what I call retail, most normal people, you can't. So you get in there, you're like, oh, market's at 11,000. Let's jump on in. And within the first it's like the first 20 minutes, the market was already at 11,100. Okay. So you're thinking, I better move fast. I better have watched, Chicago Quantum's video, decided I'm going to buy, and I get in there and I buy. The whole day, the market was flat then. It went up a little, it went down a little. It was flat, flat, flat. And so what this told me was, it's the same thing with the S&P 500, although it's a little odd, right? So in the first three, so open, 20, 40, 12, 24, 36 minutes, the market had really moved. Maybe the first hour. We'll go the first hour and we'll say, okay, we're at 37.60. Well, the market closed 4 points higher. So it went up a little, down a little, up a little, down a little. And so I struggled yesterday, and then people were very pessimistic into the close. So it closed lower. There's the Dow. So I felt cheated yesterday. Like I couldn't participate. There were certain stocks or sectors I might have wanted to invest in. Logistics being one of them. Do you know logistics cost as a percentage of GDP at the highest level in 13 years? I don't know that I buy the data. I don't know that it's right. But logistics cost, this is going to be important as you analyze like retail stocks or housing or anything that moves product, right? Logistics cost soared 22.4% last year. And it is now 8% of US GDP. To put that in perspective, all healthcare, all the drama about healthcare and Obamacare, you can keep your doctor if you like your doctor and all that. Drugs, hospitals, all of the outpatient stuff, I think even eyeglasses is 12% of GDP. So logistics is now 8% of GDP. All healthcare is 12% of GDP. It just shows you what's going on. Business spending is up almost 40% on things like private fleets or dedicated carriage. So not buying, on the spot market. And spending on waterborne services is up almost 24%. Parcel delivery jumped 16%. So what I'm struggling with is So, and then here's the thing we talked about yesterday. This is very important. All things being equal, higher borrowing costs, and we're going to take a quick look at that, will continue to push up the expense of holding the billions of dollars of inventory that companies have. So all things being equal, retail and anything that holds inventory, building houses, it's going to be more expensive. So Jeffrey, yesterday you told us that interest rates were up, but yet today you don't seem so certain. And that's true, because yesterday something very odd happened. We're going to talk about that one too. This is about interest rates now. So the 1 month is down below 1%. Oh, it's at 1%. I guess it hurt us. I want you to think about this. Over 5 days, it had gone up to just about 1.2. In fact, it hit 1.2%. Over 30 days, or a month, 20 trading days, you see it had risen from 0.5 to 1.2 and is now down to 1.0. So short-term money still costs you 1%. It's not quite the 1.5 that I thought it was going to, but it's 1%. It's high. Short rates went up double, from 0.5 to 1.0. The 10-year looks great. It's down to 3.21. Looks like long rates are coming down, right? Let's celebrate. But actually for the month, they were at 2.75. They hit 3.5, and now they're moderating below 3.25. So it's still high, but it's not quite as high. If we look at the 30-year Treasury, it's at 3.3. And this one's interesting. It's down as well. And you can see that the 30-year Treasury was below 3, just below 3, 297. And then it came up to 3.43, and then it dropped down to like 3.3. So 1%, 3.2%, was that 3.3%? So what this is showing you is that the drive to U.S. fixed income risk-free assets was super high about a week ago, and it's come back down. Now, something's happened since then. Dollar yen has gone crazy. Let's go back to FinViz. Love FinViz, by the way. I know I like Cohen too, Pumpkin. I'm sorry. I don't want to be playing favorites here. Market looks a little red. So the Japanese yen, you see how it fell, and now it's falling again. So what happened is if you take a look between May and June, you'll see how the yen came up. So I think people were trying to figure out what's going to happen with the Japanese economy and the Japanese kind of easing, right? What's happened with China? What's happened with our major trading partners, Mexico, Canada? And I think, in fact, the euro, it strengthened. It was up to almost 1.08 for a little while there, and now is stabilized at 1.06. So $1.06 for a yen. So I think the currencies are driving U.S. rates. I think demand for money is driving U.S. rates. And I think just an unwillingness to hold during odd times. So let's take a look at the 30. Excuse me, I'm so sorry. Woo. Yeah, it's not the COVID, but sickness has hit our house again. Colds. Sucks. All right, 30-year bonds. When the 30-year bond goes up to, like, let's say an example, over 140, as it was in late May, right? That's tricky for the market, because when the bond goes up, The banks that hold it, the investors that hold it, the money funds that hold it, the pension plans that hold it, they make money. Now it was 150 earlier, then 140, and it's been testing the 130 lows. 10 years got the same picture. And so we are very bearish right now on anyone that holds long-term money. If you borrow short and lend long, if you are taking in fast money at 1% and you're buying 30-year bonds and you're holding them, you are really suffering right now in this market. And I believe your losses will be fairly sizable and dramatic. A 30-year and 10-year, and I don't care if it bounces a little bit on an up day. Look at the down candles. I don't know, can I hold that? Yeah, let's do this. Let's hold it and let's take a quick look-see. So this is, it's not even on the chart. 30-year bond, oh, look at that, look at that, look at that. 155, it was nice and stable, now it's dropped. And you can see that this the bloodletting from 142. Big, red, juicy candles. Now, it reversed. More juicy red candles, it reversed. It's coming down and it reversed. And so what I would say on this one is I would not be holding long duration, long maturity bonds, U.S. Treasury. So how did they do though? So Jeffrey, you talk a lot about bonds, right? Now we're moving towards interest rates and bonds. So all issues yesterday, it was an up day yesterday, right? Excuse me. Yeah, I'm very distracted today, actually. It's not just the phone and the cat and everything, it's all this. So just stick with me. Stick with me. I'm having a rough morning. So advancers to decliners, right? So this is corporate government bonds yesterday. Yes, Jeff, show me it was yesterday. Last updated yesterday. This morning, actually. This morning. So they do a day behind. So 2-to-1 advancers to declines, all corporate issues, all corporate bonds. What's interesting is you would think the highs to lows would kind of mirror the advances to decliners. Because if you had 3,200 advancers, you'd think a few of them maybe hit a new high. It's not true. The 52-week highs, there were 18 of them. The 52-week lows were 1,700. You're looking at 91-to-1. New low to new high ratio. So when I talk about there's too many new lows, this is one of the things I'm talking about. There's just too many new lows. Okay, I'm going to save that. Let's take a look at agency debt, which Fannie Mae, Freddie Mac, Federal Home Loan Bank. I don't see Ginnie Mae here because I think Ginnie pays back the principal every month, and it's not really considered a bond. It's more of a money management system. Oh, decliners were ahead of advancers on an up day, and new highs, new lows. There were 16 new lows for every new high. So there is still weakness in the residential mortgage market. Okay, mortgage-backed securities. Now, I've been starting to track mortgage-backed securities. Where are they? By the way, I feel like death warmed over right now. I'm just coughing. I don't like it. It hurts. Actually, it hurts a lot. We're going to look at the Freddie Macs, and we're going to look at the Ginnie Maes. And there's a reason why I'm looking at these. Chest hurts. Don't get a heart attack now. I'm right in the middle of my video. It feels like a heart attack. God, I hate this market. So Ginnie Maes did okay, a little mixed, did okay. Up 0.05, down 0.4. Those are the 30 years. The 15 years were flat. 30-year fixed rate is up 4 basis points. That hurts. Freddie Mac's down 3 basis points, down 2 basis points for the 30s, flat for the 15-year. So it's not great. Your mortgage-backed securities are down. So I had heard a rumor that some banks like to hold mortgage-backed securities in order to take in depositors' money, make a profit, and then use that money to pay a dividend. Now, I can understand that with insurance companies. Banks, you're supposed to be making loans, not pumping money into the mortgage market. Yeah. You've seen 3 days in a row of losses in the mortgage-backed securities market. So that's interesting to us. So I don't see new highs, new lows. I just know that they're down. A standardized mortgage-backed security is lower. So what else did we see? So one of the things I find interesting about this market is through June, end of May to June, this is the S&P 500, the NASDAQ, and the Russell. So it was up. Did great, up 6, 8%. Everyone's happy. Then it came right back down and gave away the losses, and now you're down 6%. So it's a 14% swing, 12% swing from less to the extreme. Now you're coming back up a little. But I struggle with this, right? Because an average investor doesn't want this kind of volatility. They really don't. Kids home from college might. That's where they're going to make money, but not normal people. So what else? We looked at, FinViz does a nice new highs to lows. So let's first look at advancers to decliners. I love it. You have 6,007 advancers to 2,260 decliners. I'm going to save these because I think I'm going to do a blog post on it. Then you look at new highs to new lows. You got 32 new highs. You got 329 new lows. This is on a day when the market went up a fair amount. It was fairly broad-based. And now you have 10 to 1 U.S. equities. Lows to highs. I don't understand, right? And so let's say you bought a stock 50 days ago. 50, it's actually 50 trading days is 2.5 months ago. 15.5% of your money of your stocks are above where you would have bought them on average 50 days ago. 14% are above the 200-day simple moving average. So you lost money, right? You're not feeling good. So any time that the market decides it's going to rally, what I would say is just remember the big picture. If you're out there, just remember one day looked great. I don't know why Facebook is down. PayPal, Capital One. Oh, Synchrony Financial, I know. I think Synchrony has an issue. I looked them up. I don't know if they're on my list of bad banks or not, but we should take a look at that. I think they may have some exposure that we don't like. This is one day. It looks great. Look at that, one day. How about a month? Yeah, over the month. It's funny because some of your business to business is looking good. Cisco, IBM, Accenture, Oracle, Microsoft, Google, Amazon, Costco, Dollar General. So for the month, UPS, FedEx, Raytheon, Boeing, Eli Lilly, Humana. You go 3 months, now you're really red. Except for telecom, right? Telecom held its own, and energy is still higher than it was 3 months ago. But look at the banks. The banks are down like 20, 25%. So for the past 3 months, when mortgage-backed securities started to drop, when interest rates started to rise, you see the banks started to collapse. And so at some point, when do the banks really collapse? When do they start to have to buy each other up? I don't know. But I think we're going to find out in this next earnings season. We are not bullish on banks. We're bearish. So So you take a look at the VIX at 30.9. It's like just tells you basically the standard deviation of the moves, right? It's pretty good. I want to know. It's divided by 19. What's 31 divided by 19, Jeff? 1.5? 1.55? Let's call it 1.55. So what that says is the S&P 500 standard deviation, probably two standard deviations, is 1.55. So 68% of all the days are going to be within 1.5%, plus or minus. That actually sounds about right. DAX, Euro down, Nikkei down. Markets are set to open lower. What's interesting is bonds are set to open higher, which means yields are coming down. So these are in contradiction to each other. When you see bonds green and you see stocks red, you should scratch your head a little bit and say, why is that, Jeffrey? Why is it? Because money's cheaper to put in the stock market. I know it's not quite that simple, but it's pretty simple. Oh, copper keeps falling. So this is a recession thing right here. When you see copper falling, so copper is like the $100 bill for industry. So when copper drops to below 390, it's not helpful. That's so not helpful. Because that says we don't need to make electronic equipment or motors or electric vehicles or computers or anything. We don't need to make anything, right? So copper's down. And what I would say, I'm guessing if we go back 5 years, this is a weekly chart. This is going back 2017. I mean, copper has been as low as $2.50. It loves it. $2. Look at that. Could have bought it during the March crash at the post-COVID pandemic correction at $2. By the way, this looks a lot like the Russell, the chart. And so it came up because we were starting to produce, right? FCX, Freeport McMoran, makes a lot of copper. So my guess is FCX is down, right? And copper's down. But if you take a bigger picture, copper's actually returning back to historic levels. Okay. Jeffrey, that's fine with me. I love it, right? Let's look at silver. Silver's still elevated above historic levels. Silver's normally like a $16 metal. Still up at 21. Gold, 1300 was norm. 1800, not the norm, right? So I guess if you look at things, it's fine. We should look at energy. Energy is going to be a little different. This is the chart that should make your head spin, right? Gasoline at $1.50. And when it goes below $1.50, you should be putting it in a tank in your backyard, right? But now you look at it, right? So from $1.50 to $2, and now has a relentless climb. It's doubled. This is wholesale, before additives, before transportation. So this is the price that you pay before you put it in the truck and before you make it super premium by adding all of your engine-saving additives, right? If we look at crude oil, West Texas, intermediate, you see $40 to $60, and we've seen it lower. We've seen it at 20, we've seen it at 80 or 70. But for it to have climbed from about $40 to 120 is a pretty dramatic rise. So there's your West Texas intermediate. There's a possibility that as the market, as the economy, the core economy starts to flatten out, that all these commodities return back to more of a natural level. Then you've got crude at, let's say, 40 to 80. You can live with that. metals, right? You know, silver going back to 16, copper going back to $2. Yeah, can live with that too. But the dislocation as people have invested and people have made speculative bets, that's where it gets tricky. So I'm looking at a very red open today. So we wore a blue shirt because we're still not sure what this all means. Because interest rates look good, they're coming down. So mortgage rates will come down, recessionary fears come down. The VIX is up 0.5 point, right? So this is saying we're expecting to see some more volatility in the market, and it looks like the market is going to open down 1 to 1.5%, 1.4 negative on the S&P, the Nasdaq down 1.5, the Russell down 1.4. And so I want to thank you for listening. This is Jeffrey Cohen. I want you to be safe out there in the market. Maybe I'll share with you one more thing before we take off, which is, let's show you some of the sectors that we follow. So we're following regional banks. This is look pre-market. Where are we? So this was helpful yesterday because you saw that the whole market was going up. Let's see. So pre-market banks down, except for Broadway Financial. Those are your regionals. Let's look at high beta stocks. This was updated like a week ago, so it's not the most. Coinbase down 8%. So you can't even really play that stock because it's already down 8%. So high beta stocks are down. Money managers down. Specialty retail. You know, it's funny, right? Bed Bath & Beyond is down. Dillard's is down. Zumiez is down. Not much is up. So it's like a game. You know what? This is the point. It's like a game. And you and I, if you're in retail, you can't win. So I'm going to suggest that these days in summer where there's less liquidity, you may not want to play this game right now. Because let's say you wanted to profit from the swings in the market. And you said, you know what? I follow Jeff's video and I see that, you know, specialty retail and furniture is a bellwether, right? I want to bet on it, or I want to bet on my high beta stocks, right? Jeff puts out a list, probably updated about once a week, sometimes more often, sometimes less often. You go to our website, which is chicagoqualm.com. You go to investment information. You go to negative beta stocks or high and low beta stocks. Let's look at the high and low beta stocks. This was through June 10th. It's 12 days ago. You say, oh, I want to make bets in Silvergate and Coinbase and Digital Turbine and SI Time and Trade Desk and Lending Club and Centrus Energy because I want to really, I got a feeling that the market's going up today and I want to play the betas. Or I don't really like the market and I want to play the low betas, Kellogg's and some banks and a lot of banks actually, Newmont Mining, right? Gold stock. I just want to play the safe hand, right? So you get in and you say, okay, I want to be in Coinbase. And then you look and you see that Coinbase is down 8% already pre-market. So the move's already made. I don't think normal people during the trading day are going to have a chance here, right? Crypto and miners. Now, these guys move during the day. There's still some play. By the way, I've been having debates about Cleveland Cliffs with people online. And by the way, I love it if online you tell me that my ideas are terrible and that you can't believe that I have these feelings about these stocks and these thoughts, right? So Cleveland Cliffs, I talked about how the data did not support an entry at $22. And I'll admit, I love Cleveland Cliffs. I still love the company, but I don't love the stock at $22. Then it came down, and they're like, Jeff, you got to love it at 20. I'm like, I don't love it at 20. And I don't even know that I love it at 17. And this has gotten people very angry with me. Well, why is that, Jeff? Why don't you love it? Well, that's a good question. Why don't you love it at 20? Well, if we look at the steel industry and we look at scrap, so Cleveland Cliffs, and we'll let it pull up while we pull the other one up too. Cleveland Cliffs buys scrap because they bought an electric arc furnace company, AK Steel. They may also have some exposure to integrated. So hot rolled coil steel. This is the best steel that there is. $8.90. I'll tell you, this thing was $1,400 when we first started looking at it a month ago. So you're down $900. You're down like 50%. And if you look, you're lucky to get $8.90. Because now, if you sell out in the future, you're getting $8.50, $8.75, $8.80, $8.70. So if you're Cleveland Cliffs, I don't think you want to rely on, oh, I got customers and I'm going to sell them some hot rolled steel right off the truck, spot market. You might, but you might only get $400 for it. So you want to sell forward, or you want to hedge, right? So it's not helpful. How's scrap? Well, scrap came down, thankfully. Look at that, 520, 475. Scrap's up. So scrap's up, and hot rolled steel is down. That means Cleveland Cliffs, U.S. Steel, Nucor, MT, ArcelorMittal, they're all on the toilet, right? Take a look at Freeport-McMoRan, one of the largest copper makers. So, Jeffrey, I love the copper business. Well, let's take a look at hourly. Now, let's take a look at, yeah, there it is. Go back into May. Ooh, everything went up, and that thing came right down. And I bet you, if we were to put copper over it, you'd see the same thing, right? Copper's up, copper's down. It's down 5% pre-market. Maybe people heard the video. Copper's going to $2. Oh my God, Freeport-McMoRan won't be able to pay its loans. We're in big trouble. So each of these stocks has a story. All right. I want to thank you for listening. Market opens in about an hour and 10 minutes. And so we don't get paid to make the videos. If you like the video, leave a comment. We love when you do that. And hit the subscribe button. It's free. It shows YouTube that you like the video, that you like us, that you want to be notified. You can then be notified when we go online and we make a live stream, and it really helps us out. So thank you very much. Good luck in the markets. Net, it looks like it's going to be a red day today in the markets, and it looks like interest rates are going to be a little better today, at least at the open. So good luck. You take care now. Bye-bye.